Prime. Joining us today is Mr. Sudhir Singh. He's the CEO of Coforge. He's speaking to us a day after the company reported its first quarter results, where the revenue went up sequentially, net profit went up 44%, but the margin was down by 400 bips. Mr. Singh, welcome to BQ Prime.
Thank you very much for having me. Glad to be here.
Yeah. While the results have come out, what stood out completely that you have maintained your revenue guidance for the entire year at 13 to 16%. Please take us through this. What gives you the confidence to maintain at your guidance at such high levels?
Well, they're really not high levels compared to where we are. If you look at the state of the business, if you look at this quarter, if you look at the last 2 quarters, the ramp that we built up, unlike a lot of our other peers in the industry, is very different and it's far steeper. So for us to deliver 13 to 16%, all we need to do is to deliver slightly less than what we've delivered in Q1. And the intent obviously is to do a lot better. So when we look at our numbers, when we look at metrics like the order executable, which is the locked in orders over the next 12 months, which are right now 19.1% higher than where they were about a year back. When we look at Coforge as a firm and our performance over the last 6 years, the growth in order executable, if you correlate that with the revenue that was realized in the subsequent 12 months, there's been a very strong correlation. Our order executable is at 19.1% higher than where it was, and I said this earlier, 12 months back. The guidance we've given is only 13 to 16% CC growth. In a quarter like Q1, we've grown 2.7%. More importantly, we've signed a $300 million deal in BFS, a stressed sector. Our order intake has been the highest in the history of the firm. So you tally all of this, large clients doing very well, large deal velocity, large deal size going up. Our net headcount in our case again has been an outlier. Our net headcount has gone up by 4.3% given the work that is already locked in, statement of works which are there. That's where the confidence comes from. So we're not just looking at macro and looking down and looking at what the peers are talking about and calling out. We are looking grounds up. We are looking statement of work by statement of work, MSA by MSA, client by client, prospect by prospect. 13 to 16%, every which way we've stress tested it, is a guidance that we will, and I say this with absolute conviction, we will positively, definitely, under every scenario, deliver upon. No question about it.
So would you consider yourself as the outlier in this current scenario in the Indian IT space?
Well, I'll let you be the judge of that. You obviously track the other firms a lot more than I do. I know this for a fact, 13 to 16%, the number that we've given. You look at our track record over the last 6 years, we've never missed our guidance. We don't intend to start doing it this year. That number we will deliver.
Okay. Very interesting point that you made was about the BFS segment. There definitely you have clocked a $300 million deal that you have said. Your BFSI is... the BFSI revenue is up this year. Again, how are you doing it? I mean, I was looking at your numbers. I'm saying that's quite opposite to what we have seen elsewhere. So how are you scoring these BFSI deals as well? Who are the clients?
Well, as you can imagine, banking clients, the clients with whom we signed 2 large deals in BFS this quarter. One of them is an asset and wealth management major. The other one is a large retail commercial bank. We've always said this, and I said this even when the going was good and we were doing extremely well, others were doing well, that it's only when the macros are tough, when demand is uncertain, that relative performance becomes important, and performance of firms across this industry will get very widely dispersed. We've been prepping for this time. We've got the right leadership. We've built the right capabilities. If there's one thing that we do right and we pride ourselves upon, it is our execution intensity. Everything that we do is grounds up. Capabilities that we built come from a very, very solid base. 2/3 of this billion-dollar organization is focused only on financial services. That means the inferences, 2/3 of the 25,000 employees, team members of Coforge focus on that space. BFS is a space where we think we have very deep, very differentiated capabilities and an exceptionally strong relationship engine at the front end. That's why we're gaining significant wallet share, even though the size of the wallet is dropping.
Okay. Going ahead, so yours is a 30 to 16% guidance. Things looking bullish right now. What would be some of the challenges that you expect to face in the rest of the year right now in FY24?
Really, nothing material that's going to come in the way of 13 to 16%. I mean, there could be challenges if you were aiming for more than 16%, but 13 to 16, if you look at what we've done, we have been an outlier, and I said this earlier, in the fact that our headcount has gone up by 1,000 employees. Our headcount in Q1 has gone up 4.3% at a time when other firms have been cutting headcount.
Yeah.
We've taken the hard decisions in Q1 itself. On the 1st of April, on the first day of Q1, which is when our annual increments are given, we did not delay anything. 100% of our employee universe has been handed over the increments. In Q1, annual bonus of last year, unlike some of our peers, we've not delayed any of that. We paid all of it out. We have not gone back and taken away any offer made to campus hires or to lateral hires. That's why our headcount has gone up. We are looking at the business that we've signed. We're looking at the resource requirement that we have, and that's why we've signed up for 1,000 people. So that's how I would pose it. That's where we're heading. That's what's building up as an answer to that question.
Okay. If I remember correctly, in the previous quarter also, it was the first time that you hit $1 billion in revenue. Where do you think the next $1 billion is coming from?
It's going to come largely from the same set of clients that we have. The big change that's happened over the last 5 years as we move from 400 million to $1 billion is that when it comes to banking, insurance, and travel, the number of tier 1 clients from these industries has gone up. We take a lot of pride in the fact that in 5 years, we moved away from having 9 Global 1,000 clients to 61 Global 1,000 clients. So a lot of the growth is going to be organic from the clients we've already acquired. And farming is going to be a big engine. The second avenue of growth for us is going to be the new verticals that we will establish. We will, before the end of this year, possibly call out public sector as the 4th vertical, and hence the 4th growth driver of the firm outside banking, insurance, and travel. For us, a lot of growth is also going to come from the tech capabilities that we've incubated. Data analytics infused with AI is a very strong growth engine for us. Cloud-based services continue to grow for us, despite the uncertain macros that everyone's talking about. So it's going to be a mix of new vertical addition. It's going to be a mix of very active farming under a customer success officer framework that we built. And it's going to be a mix of going after select, high potential, scalable must-have accounts.
By when do you think that will happen? And the second question here is, can you also explain the margin decline that you have seen in this quarter?
So we've said this earlier. We believe that it will happen in less than 5 years, not in 5 years, in less than 5 years. And we don't feel comfortable at this stage in giving the specific year. But our intent is to get there with the fastest possible speed. And to that extent, we will also look at inorganic acquisitions, starting as soon as we can identify the right asset to make sure that we get to 2 billion with great speed. As far as margins are concerned, margins are absolutely in line with the margin progression that happens in Coforge every year. If you look at the last 3 years, Q1, including this year, Q1 is always 16 to 16.5%. And after doing 16 to 16.5% for the full year, we've delivered between 18.3 to 18.7. This year, if you look at us, in Q1, our headcount has gone up 4.3%. So we've taken that hit in Q1.
So most of the costs are to wage costs.
Yes, they've all come in. The bench is there to staff. We take all our annual visa cost in Q1. Correct? And the third thing that's very important is the way we do our P&L is hedge gain and loss is netted off against revenue. Now, this year in Q1, the results that we declared yesterday, we had a loss. Last year in Q1, we had a gain. The difference is 60 bips. So on a like-to-like basis, our margin in Q1 compared to last year is actually 10 bips higher. And all that we've told the market is that we will come around for the full year at the same margin levels. We haven't talked about an expansion in margin this year. So it's going to be the same story. It's not a new attempt at trying to do something that we haven't done earlier. Every year, Q1 is 16 to 16.5. Every year we've delivered for the last 3 years, including this year, 18.3 to 18.7. That's the contention. And that again, given the investments we've done up front, salary cost is fully baked in, hiring has really been done with speed. I think, and I believe, and I more than believe that we will deliver on those things.
So, at what operational profitability do you want to exit FY24 at?
The same levels that we did last time. If you look at us last year, Q4, if I remember right, was around 19.6%, which fundamentally meant that for the year we delivered around 18.3%. We would like to have a RAM that is reasonably similar to last year's RAM.
Got it. One final question, sir. There's a new field called Generative AI. There's a lot of buzz. Just wanted to get a feel of what Coforge is doing in that space, sir.
Absolutely. So generative AI, of course, is the new buzzword after the cognitive AI space that, like a lot of other organizations, we've been intensely focused on. Coforge has not just embraced AI. We started doing that 5 years back when it was more centered around cognitive. We're also now in a stage where we're trying to institutionalize it across the organization. As we speak today, we've already created 100 solutions across 40 clients, 40 of our existing clients. A mix of both cognitive and Gen AI. Our growth pattern, our growth forward strategy around Gen AI fundamentally has the following pillars. The first is partnerships with hyperscalers and partners, including, of course, the hyperscalers, but the Pega, the Salesforce, and the ServiceNow right now. The second aspect of that has been the AI trained pool across the organization, which currently stands at about 1,000 odd trained on AI centric technologies across the hyperscalers and partners. We intend to double it over the next 2 quarters. The third prong is the partnerships that we've established with academia, with MIT, the Massachusetts Institute of Technology, with the UPenn, University of Pennsylvania. We already have an active collaboration going on in terms of populating the AI innovation COE that Coforge has and driving growth. The fourth thing that we are doing is working with the partners, making sure that we start putting things out there which are true blue solutions on their platform. If you go to Microsoft Azure today, and if you look at Gen AI solutions, Coforge already has 8 Gen AI based solutions on the Microsoft Azure marketplace, which I suspect is one of the highest that any service provider on Microsoft Azure today has. So our strategy is multi-pronged. It's not a new strategy. It's an extension of what we've done on the cognitive AI front. And Gen AI, just as we embraced and institutionalized cognitive AI, is going to follow the same pattern within Coforge. We've embraced it. We will now, like cognitive AI, try to institutionalize it.
Any dedicated investment that you have towards AI? Have you earmarked some cash towards it?
I'll try to stay away from it. It's very, very difficult to call out analytics, automation, and AI investments as separate. Everything that we are doing, the strategy we're following is an AI first strategy. So service lines like even product engineering, service lines like cloud, service lines like data analytics, service lines like automation, all of them, the investments going in have a mix of AI. I'd like to stay away from calling out a specific number because it's going to become like the whole conversation that we used to have around digital with everybody competing to talk about whether it was 30, 40 or 70% of the revenue. But anything and everything that we're doing by way of investment, the lens that the firm is carrying is, as part of the AI first strategy, do we have an AI component investment linked to that component into the overall investments?
Okay. What about training of the staff in this new technology in Gen AI? How to make them upskill them in this new sphere?
Yeah, as I said, already done and dusted.
Okay.
Trainings, another 1,000 to be closed in the next 2 quarters itself. So if we speak 6 months from now, that 1,000 will be 2,000, and then of course we'll try to accelerate it further thereon. We have the partnerships that we have with MIT, for instance, fundamentally have been established to make sure that our folks aren't just getting trained on AI, but they're also getting exposed on an ongoing basis to the latest generation, not just the 3.5 LLM model of GPT, but 4.0 and the ones that are going to follow there.
All right. Thank you so much, Mr. Singh, for joining us today. It was quite an insightful chat. I seriously consider that your performance has been an outlier so far. I hope all the best for the rest of the fiscal.
Thank you very much. It's been fantastic speaking with you.
And thank you, viewers, for tuning in. This is Tushar for BQ Prime.